Welcome to Celebrity Investing, your go-to source for insights, tips, and updates on navigating the exciting landscape of personal and global finance. Please like, share, and subscribe for more exclusive content. This is part 1 of how corporate social responsibility shapes smarter investment decisions. Investors are paying closer attention to more than just profits when deciding where to put their money. Corporate social responsibility, CSR, has become a key factor in how companies are evaluated, not just by customers but by those looking to invest. Businesses that prioritize social and environmental impact often stand out as safer, smarter, and more attractive choices. For investors, aligning portfolios with ethical and sustainable practices isn't just a trend, it's a strategy that reflects growing concerns about long-term value and accountability. What is corporate social responsibility, CSR? Corporate social responsibility, CSR, refers to a company's commitment to operate in ways that enhance society and the environment, beyond just making a profit. It's about taking accountability for the impact a business has on the world, whether that's through reducing pollution, improving employee conditions, or supporting local communities. CSR has shifted from being a nice-to-have to a must-have, as both consumers and investors seek transparency and ethical practices from organizations they support. The 4 pillars of CSR. CSR is built on 4 main pillars that define the key areas where companies can direct their efforts. These pillars ensure businesses consider more than just financial success, they strive to make a positive mark socially, environmentally, and economically. Environmental responsibility. Companies are increasingly expected to minimize their environmental impact. This includes reducing carbon emissions, managing waste responsibly, promoting renewable energy, and using resources efficiently. Businesses engaging in eco-friendly practices often improve their public reputation while aligning with the growing demand for sustainability. Ethical labor practices. Fair treatment of employees is central to CSR. Companies ensure safe working conditions, fair wages, and equal opportunities. Beyond their own workforce, businesses are also scrutinizing their supply chains to ensure ethical treatment at every level. Exploitative labor, such as child labor, is a critical issue brands can avoid by choosing responsible sourcing practices. Community engagement. Businesses can strengthen ties with their local and global communities by giving back. This might be through charitable contributions, partnerships with nonprofits, employee volunteer programs, or implementing initiatives to address social challenges like education or healthcare. A strong presence in community efforts helps companies build trust and goodwill. Economic responsibility. While profitability is essential, CSR encourages companies to focus on economic practices that are sustainable and equitable. This can include fair pricing, responsible investments, and paying their fair share of taxes. By building long-term economic relationships, businesses create value not just for themselves but for stakeholders at every level. The history of CSR. The idea of CSR didn't appear overnight, its roots stretch back decades. In the early 20th century, companies like Ford began offering higher wages and better working conditions, which hinted at the early stages of social responsibility. Back then, CSR wasn't formalized, but some businesses recognized the long-term benefits of treating workers and communities well. By the 1950s and 1960s, CSR started to gain traction as a concept. Academics and business leaders began defining the social responsibilities of businesses, emphasizing the idea that companies should give back to the society that supports them. In parallel, the civil rights movement and environmental movements of the 1960s and 1970s put pressure on corporations to be more ethical and environmentally sound. The 1990s and early 2000s marked a major shift as globalization exposed exploitative practices in supply chains. This era also saw rising consumer awareness. Buyers began demanding more transparency about how products were made. New CSR frameworks, like the triple bottom line, people, planet, profit, emerged to help companies focus on social, environmental, and economic impact. Fast forward to today, CSR is no longer optional. Governments, investors, and consumers hold businesses accountable for their actions. Movements like ESG, environmental, social, and governance investing have made CSR an essential part of corporate strategy. Companies now tie their social responsibility goals directly to their brand identity, building loyalty through shared values. As CSR continues to evolve, businesses are finding innovative ways to integrate this ethos into their operations, making it a standard for successful and sustainable growth. How CSR impacts investment decisions. Corporate social responsibility, CSR, plays a growing role in how investors evaluate companies. Today, it's not just about balance sheets or profit margins. Investors want businesses that reflect their values and demonstrate long-term reliability. Companies actively committed to environmental and social governance often signal stability, purpose, and resilience, qualities that appeal to modern investment strategies. Let's explore how CSR directly shapes investment decisions. The rise of ESG investing. Environmental, social, and governance, ESG, investing has emerged as a powerful framework for aligning financial goals with ethical priorities. These three factors overlap with corporate social responsibility, offering investors a lens to evaluate businesses based on their societal and ecological impacts. Investors use ESG criteria to assess how companies manage risks, handle community relations, and address environmental challenges. For example, environmental metrics look at energy consumption, carbon footprints, and resource management. Companies with green initiatives, like reducing emissions or adopting renewable energy, often rank higher for ESG-focused funds. Social considerations include fair labor practices, diversity in leadership, and how companies engage with their communities. A company known for poor working conditions can deter investors looking for socially responsible opportunities. Governance evaluates transparency, ethical decision-making, and executive accountability. Scandals tied to poor governance or corrupt practices can tank stock prices overnight. Companies that align their CSR efforts with these ESG pillars tend to attract more interest from institutional and private investors alike. Integrating these principles isn't just a feel-good move, it influences bottom lines and positions businesses for sustainable growth. Investor sentiment towards CSR. The shift in investor attitudes towards socially responsible investing, SRI, is backed by numbers. Studies consistently show that more individuals and institutions are looking to put their money into companies with a clear CSR commitment. According to the 2023 Global Sustainable Investment Alliance report, sustainable investments reached over $35 trillion globally, reflecting almost 40% of all assets under management. Morgan Stanley's 2022 study found that 85% of individual investors were interested in sustainable investing, with millennials leading the charge at 95%. Why this surge in interest? People increasingly recognize that companies with poor social or environmental records often face significant risks. On the other hand, businesses with strong CSR programs not only avoid these pitfalls, they also tend to drive innovation, engage loyal customers, and reduce operational inefficiencies. For investors, it's not just about doing good, it's a way to direct capital toward companies primed to thrive. CSR as a risk mitigation tool. Strong CSR practices don't just add value, they shield companies from preventable risks. Think of CSR as a defensive strategy safeguarding a company like armor in a battlefield. Consider these scenarios. Reputational damage. Imagine a company exposed for unethical supply chain practices. Social media can amplify these scandals, leading to boycotts, lower sales, and falling stock prices. Transparent CSR efforts help win trust and avoid such public relations disasters. Regulatory compliance. Governments are introducing tougher regulations on issues ranging from carbon emissions to worker rights. Businesses with robust environmental and social policies are often ahead of the curve, avoiding fines and operational hiccups. Financial instability. Ignoring environmental risks like droughts or floods can disrupt operations, especially for resource-dependent industries. CSR policies that factor in climate change help create contingency plans and maintain stability. For investors, risk mitigation is a key consideration. Companies that embrace CSR often demonstrate foresight and reliability, making them less vulnerable to the unpredictable shocks that could harm their bottom line. CSR's value goes beyond goodwill. It's a fundamental strategy that companies use to navigate complexities while staying appealing to investors. Stay tuned and continue to watch our videos to gain valuable insights into the world of finance. Subscribe, like, and share to continue your journey to financial success.